Hello and welcome to Cafe Mutual YouTube channel. Friends, factor funds, which is commonly known as smart beta funds, have been gaining a lot of popularity among investors. In fact, as we speak, the AUM of factor funds has reached close to 25,000 crores now. So, to understand more about this category, today we have invited Arun Sundaresan, Head ETF Nippon India Mutual Fund. Arun has over 20 years of experience in the fund management and product development. So, without wasting time, let's welcome Arun. Good evening, Arun.
Good evening, Nishant. Pleasure to be on this show.
Passive funds are meant to mimic market performance. However, factor funds aim to outperform broad-based indices. So, Arun, can you tell us how a passive fund outperform broad-based indices?
Sure. So passive funds come in two formats. One is ETF, exchange traded fund, and the other one is index fund.
Hmm.
So exchange traded fund, you need to have DMAT, and units are listed on the stock exchange and you can trade.
Hmm.
Whereas an index fund is more like any other mutual fund. You buy at the end of the day, buy or sell at the end of the day. But the commonality between both of these formats under the passive fund is that they track the underlying index. So
Hmm.
whatever is the index, the returns have to be closer to the index. It does not do anything more or anything less.
Hmm.
So that's a concept of passive investing. Now, generally, when it comes to when you're saying you're investing in market, investors generally tend to think about the broad markets,
Hmm.
like they tend to think about Sensex or Nifty. Then probably they could think about mid cap or small cap. All these are market cap based indices, meaning the largest stocks under each sector. For example, Nifty 50 is the top 50 companies by way of market capitalization. And generally, people associate those parts of the markets to be market in itself.
Hmm.
However, factor investing is a type of investing where you do not focus on market cap per se. You tend to focus on specific factors that could possibly drive or explain returns. So
Hmm.
that is what is called as factor investing or smart beta investing.
Okay. So, for the benefit of our audience, can you help us understand types of factor funds?
So there are a lot of factors available already. So as I said, factor investing is very different from the generic approach of being market cap oriented, like investing in large cap, mid cap, or small cap. Rather, you focus on uh, those factors which may be explaining returns, like for example, value. Right,
Hmm.
value is a type of investing where you try and identify stocks which are relatively cheaper than its intrinsic value. Likewise, there is another factor which is called as quality. So quality tends to focus on those companies which have, let's say, higher return on earnings, the consistency of those earnings, and so on and so forth. Likewise, that can be another factor called, let's say, momentum, which focuses on those stocks which are doing very well.
Hmm.
So these are just a few factors. There are many more. Once you have a set of factors, you can also combine them in various proportions. For
Okay.
example, you can combine, growth with momentum. So you look for those companies which are fundamentally having the growth metrics. Those metrics are strong. At the
Hmm.
same time, momentum is very strong. So likewise, if you combine various factors, you have enormous possibilities for these factor funds, also called as smart beta products.
Okay. So basically, I can combine two factors or maybe three factors to get the better, I mean, to get the outcome better. Okay.
Yes, not
Uh,
only that,
hmm.
this can also be superimposed on any part of the market. If, for example, if you say that, okay, the normal investing is investing in Nifty, the Nifty 50, but
Hmm.
within that, if I apply a factor and say that within Nifty, I want to select the value stocks, you can
Hmm.
have a strategy based on that. A
Okay.
similar strategy could be applied on only mid caps,
Hmm.
or it can be applied across market caps. So
Hmm.
that's where you have multiple variations coming in, and it can be done on various parts of the market.
Hmm. So, Arun, factor funds basically follow some formula to pick stocks. I want to understand that why should investors rely on such formula to deploy their funds?
So all passive funds by definition, whether it is ETF or index fund, and within that we talked about market cap based products, right? Nifty 50 or mid cap,
Hmm.
all of them invariably are rules based. So
Hmm.
when you are saying Nifty 50, the rule is that you will invest in the top 50 stocks. This
Hmm.
is the weightage assigned to each of the stock based on the current market
Hmm.
context, and you're investing exactly as per the rule.
Hmm.
Factor investing is no different from that. So that is also rules based investing, just
Hmm.
like any other passive investing. However, depending on the factor, depending on the combinations of factors, that rule will be known to you. See, for example, what is the definition of value? Value is a factor which is known, but
Hmm.
how is value defined? That particular strategy, that particular factor based investing will decide upfront. The index providers would have decided upfront, and the stock selection will be based purely on that. So that's the only difference.
Hmm.
Obviously, any passive product, index products, ETF products, they're all rules based and it will be followed to the T.
But what if the formula goes wrong? I mean, what are the kind of risk?
See, any strategy,
Hmm.
okay, and it's not applicable only for factor investing.
Hmm.
Okay, please keep in mind that no strategy in the world
Hmm.
is the most superior,
Hmm.
which is going to work in all conditions, which
Hmm.
is risk free. There are certain times in which a particular style of investing will work. There will be another style which will work at different points in time. So,
Hmm.
therefore, that inherent risk return would be part of any investing, right? Any strategy. So when it comes to factor, I said within those factors there are multiple, there are very different factors. For example, value and quality are very different factors. So
Right.
something could be working, something may not, and in another time something else which was not working will work.
Hmm.
So that's part and part parcel of investing. You'll have to go with that. Factor investing, smart beta products, or for that matter, any of those passive products, you are using that to express a view. Suppose you are of the view that, let's say, when compared to large cap, mid caps will do well,
Hmm.
right? That's a view. It may be right or wrong, but if that is your view and you want to play that, you go and buy a mid cap index fund or a mid cap ETF. Likewise, if you are of the view that value as a style, as a factor is likely to do well for various reasons, if you are of that view, you go and invest into a value factor fund or a value smart beta product, right? Now, if the view plays out, obviously the returns will be good. It would have outperformed the market in general. And there can be times where it may not come through. So those things are part of the game.
Okay. So in Arun, in actively managed space, there is fund category called quant funds. So what is the difference between quant funds and factor funds?
Yeah. So quant fund, in a way, I can say is in between an active fund, an actively managed fund. The fund manager takes all decision by himself.
Hmm.
All decisions are discretionary. Which
Hmm.
stocks to buy, when to buy, how much to buy, what sector exposures to take. Should it be overweight?
Hmm.
Should it be underweight, how much, all of those decisions are taken by the fund managers and his team. It's
Hmm.
completely discretionary. On the other end is passive funds, where in ETF and index, it's completely rules based.
Hmm.
Those rules are set about by a third party,
Hmm.
by index providers. So if it is a NSE related product, Nifty is a NSE related product, Sensex is offered by BSE index. So those rules are set by the index providers, and the asset management companies or the funds simply replicate those indices. So those are the two extremes. Now, quant fund comes in between. So quant fund is in a way an actively managed fund. However, the rule by which the stocks will be selected will depend on the fund manager.
Hmm.
So the fund manager or the fund house would have decided on a set of rules. It may not be even in the public domain.
Hmm.
There may not be transparency.
Hmm.
Those rules might undergo changes. and the stock picking would be based on that. So conceptually, quant funds try to do what index funds do, but there are differences, like the way I explained to you. One, in index funds, there is a transparent mechanism, there is a methodology which the index provider has built in and is put it out in the public. And to the T, everyone follows that. On the other hand, suppose there is a value-based quant fund. That particular strategy could be different between one AMC and another AMC. And what could be right, what could eventually work, becomes like assessing any other fund, whether it will work or not work. You may not be too sure. So I would put quant fund somewhere in between an active fund and an index fund in terms of what it attempts to do and how it goes about doing that.
Okay. So then one last question. Considering the current market scenario, which factor fund can work well for investors?
Very, very difficult to answer that, Nishant. As I said, different strategies work at various points in time. In the recent past, momentum-based strategies have done very well, which means that, obviously in the last 1.5, almost close to 2 years, markets have been on an uptrend, which means that the markets have been going through a strong positive momentum. Therefore, that strategy has been working very well in the past. Having said that, those kind of strategies could also be volatile. See, for example, when markets go through a lean phase, if it loses momentum, so to say, it could struggle, right? On the other hand, there are strategies like value. There are factor-based funds which focus only on low volatility. So low volatility. There are multi-factor products like combining alpha that's focusing on stocks which are generating higher return than the inherent risk, and combine that with low volatility. So you're looking at two factors, alpha and low volatility. There are multiple factors, which can work at various points in time, as I said. And in general, when it comes to passive funds, the attempt should be for investors based on their assessment and their views. They need to select products. As an asset management company, our role would be to offer various kinds of strategies, whether it is market cap or different types of factor funds, etc., and then leave that investment decision with investors and possibly also with the advisors of investors.
Okay. So with that, we have come to an end to this interesting session. Thank you so much, Arun. So to conclude, smart beta funds are for smart investors.
Thank you very much, Nishant.
Yeah. Thank you. And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.